off yesterday. High and low volume areas. To conclude our discussion of day time frame trading, we will examine high and low volume areas and their use in identifying changes in the market sentiment. Market change is accompanied by both risk and opportunity. The key to securing optimal trade location is the ability to identify market change as it is developing before the change is confirmed by structure. By monitoring significant volume-generated reference points, a trader can anticipate market behavior and maximize trade location in the early stages of change. High volume areas. High volume concentrations develop when the market spends a relatively large amount of time trading within a narrow range of prices. Both buyer and sellers are active, forming a short-term balance region in which price slows to accommodate two-sided trade. In other words, the market perceives the area to be fair and volume builds over time. In shorter time frames, high volume areas represent the market's most recent perception of value and therefore have a tendency to attract price. Naturally, all markets eventually undergo change and leave the high volume area in search of new value. Should the market subsequently return to those price levels, the high volume region should once again attract or slow price. We caution that the market's memory is primarily short-term. The longer price remains away from a specific region of acceptance, the less significance the high volume will have on the market as it re-enters that region. However, with regard to the day and swing traders, an area of previously established high volume should slow price movement long enough to provide sufficient time to enter or exit a trade. For example, suppose the swing auction in treasury bonds is up, but the market probes downward in an area of previous high volume. The slowing of price should provide time to enter responsive longs and then monitor for the reemergence of the buyer. Similarly, when seeking to exit an existing long, a trader can be relatively sure that when the market moves up into a high volume area, price will slow enough to allow time to liquidate the long position. Identifying high volume levels. Depending on the data vendor, day time frame traders have three potential sources for high volume price information. The Liquidity Data Bank, LDB, shown in figure 4.42, the LDB displays individual price volume information. 4.40. Individual price volume information, as discussed earlier. With respect to isolating areas of high volume, the most significant figure is found in the percent volume column. These figures represent the percentage of total volume occurring at each price traded during the day. In figure 4.40, the area marked near the center of the range 89 to 05 through 89 to 08 represent four prices showing the greatest volume during trade on the 25th. In other words, 9.7% of the day's trade took place at 89 to 08, while 10.4% occurred at 89 to 07, and so forth. These prices add up to 40.3% of the day's trade and represent the area where the following trading sessions auction rotations should slow, allowing time to position or exit a trade if the opportunity is presented at all. The market profile graphic. For those markets without the benefit of LDB information, the market profile graphic provides solid structural clues regarding the day's high volume levels. In the absence of real volume figures, the second best measure of high volume concentrations are high TPO prices surrounding the point of control. The thick middle portion of the profile usually closely parallels the LDB high volume prices. Price should slow as it enters the fat region of the previous trading session's profile. Tick volume. Tick volume is available through several quote services, some of which now provide a tick volume graphic representing the relative tick volume for each price traded at the day's structure. As the day's structure evolves. Readers should take note that tick volume measures the number of trades that take place. It does not reflect the actual contract volume in each trade. Thus, one tick may equal 2 contracts or 2,000 contracts. quite a difference from trading logic standpoint. Moreover, on the low volume days like holidays, tick volume can register quite high because of heavy local activity, while in reality, actual volume is still low. Still, high tick volume prices generally coincide closely with the high TPO prices, therefore, may be useful estimate of high volume. Figure 4.41. When using tick volume, traders simply need to be more aware of underlying liquidity of the market in which they are trading. High volume examples. I'm going to see if where's the maybe I'll use this one. Example 1. Up auction. Probe down into high volume area. During late October, Treasury bonds were in the midst of a long-term buying auction, as demonstrated in figure 4.42. That's what I was looking for. There it is. October 25th recorded high volume prices in 89 to 05 and 89 to 08 region after a higher opening on the 26th. Responsive sellers attempted to auction price lower during A and B periods. The selling auctions eventually slowed near the area which the highest volume concentrations of the previous day. Buyers then entered the market and returned price above the 25th value area. Given the long-term direction was up and that the bond market had opened higher, traders looking for good location to place a long could expect price to slow if it auctioned down near the high volume area of the 25th. If the buying auction was exceptionally strong, however, price would not have returned to the high volume area at all. It is important to stress that traders should not expect the market to stop precisely at the high volume levels. Remember, high volume attracts price, but it is not a rigid floor or ceiling. It is logical for the market to trade around a high volume area. Thus, the market could just as easily find support or resistance before the high volume region as beyond it. The key to taking advantage of high volume is 1. Do not try to be perfect. First, execute the trade and then place your confidence in the slowing properties of volume. If price has subsequently been accepted below high volume area, traders would have been alerted that the market perceptions of value had changed. Long positions should have been exited immediately. While October 26 did not evolve into a big day, it did show general continuation to the upside through higher value placement. Moreover, when the Treasury bond market attempted to auction lower in C period, price slowed and found support to the high volume levels. Day traders could observe the downward testing 89 to 10 place longs against that level and rely on the slowing properties of volume should price probe lower. Figure 4.42, well, never mind. Example 2, down auction. Probe up into high volume area. Figure 4.43 shows Treasury bonds at the start of a potential short-term down auction. September 14th demonstrates a normal variation selling day, characterized by strong responsive selling tail and late selling range extension in K period, resulting in a close in the lower half of the range. The unusually large selling tail alerted traders to potential buying excess on the high. Figure 4.43 shows the profiles for September 14th and 15th, along with the percent vol figures for both. The 14th high volume prices span from roughly 88 to 20 to 88 to 25, accounting for 53.7% of the day's volume. On September 15th, bonds opened and auctioned within the area of the 14th's high volume concentrations. The A, B, and C period rotations within the high volume region demonstrated the time offered by high volume, time to enter or exit a trade. Traders may have chosen to use this particular opportunity in one of two ways, depending upon their level of confidence in the start of the down auction. 1. No trade until more information is furnished by the market. The morning's auction rotations within the previous day's high volume areas indicated balance. Traders may have elected to enter shorts on a breakout of this balance which occurred in each period. Two, those with more faith in a strength of a seller conviction may have used the time offered early in the morning to enter shorts with good trade location when a C period buying probe beyond the initial balance, A and B periods in Treasury bonds, met with rejection just above the high volume area, a form of auction failure. Traders recognizing the continued strength of the seller could have confidently entered short trades or exited longs. On the other hand, had prices auctioned higher above 88 to 26 and into the low volume price levels, traders would have been alerted that conditions had changed. September 15th eventually developed double distribution selling trend structure, generating overlapping to lower values in the direction of the short-term auction. Low volume areas. Low volume typically represents other time frame directional conviction. Therefore, it is likely to see low volume areas occurring in unbalanced trending markets. Low volume prices are caused by the same forces that create excess and usually exhibit the same characteristics: gaps, single TPO prints, and tails, short and long term. When the rejection demonstrated by the low volume area develops, short-term strategy is placed trades using the area of price rejection for support or resistance. The low volume area, like excess, should hold against future auction rotations. For example, single TPO prints separating a double distribution selling trend day indicate swift rejection of the initial distribution in search of a new lower value area. Shorts placed just below the single print low volume area should offer good day time frame trade location. However, if price auctions back up through the single prints, then market sentiment has changed and shorts should be exited. When price auctions through an area of previous low volume, the other time frame conviction that initially influenced price has changed. Traders should heed the market's warnings and exit any opposing trades. Imagine a low volume area as a balloon. The surface of the balloon offers resistance to the probing of the tip of a pencil. Once the pencil pierces the balloon, however, there is nothing to stop its motion in the direction of the initial probe. If a price probe penetrates the extreme of a low volume region, then a subsequent price movement is often swift through the remainder of the low volume area. However, like a balloon, the low volume area gives before it breaks. Price must often trade substantially through the low volume area before it no longer offers support or resistance. This means to identify low volume areas are similar to those previously covered in high volume discussion. The most significant measure is again found in the volume percentage column of LDB, followed by structural indications such as tails and single TPO prints, and tick volume. As an example of using real volume levels, let us examine the September 15th LDB shown in figure 4.4. Two obvious low volume price areas that come into play on this day span from 88 to 25 to 88 to 26, and from 88 to 12 to 88 to 16. The low volume at the upper extreme of the day's range represents rejection of the 88 to 26 high. The lower volumes in the center of the range suggest that aggressive other time frame sellers drove price lower with conviction. These five prices add up to only 12.6% of the day's trade and represent a region where future auction rotations will probably be rejected rather than slowed. This rejection can assume one of two forms: a dramatic reversal if the low volume area holds, visually represented by a tail, or two, a swift continuation back through the low volume area, commonly represented by single TPO prints. Low volume examples. Example 1. Low volume as resistance. At the time of this example, Treasury bonds had formed a short-term buying excess at 89 to 09. On September 14th, circled in figure 4.45, and we're starting a down auction. September 15th developed a late forming double distribution selling trend day. Figure 4.46 confirming the buying excess. Figure 4.46 displays the profiles for the 15th and the 16th and their accompanying price/volume figures. Again, the low volume areas from 88 to 12 to 88 to 16 on the 15th represents swift continuation and other time frame seller conviction. This territory should offer resistance during subsequent buying attempts, at least over the short term. Two scenarios may confront a trader looking to sell on the 16th. First, assuming an unchanged to lower opening, good trade location would be gained just below the 88.12 to 88.16 low volume region. Ideally, price would test higher and be rejected, providing an opportunity to place shorts near the 16th high. If the market is extremely weak, however, price may never auction that high. This brings us to the second scenario. Again, assuming an unchanged to lower open, if bonds show early selling via an open drive type of opening, there will be no ideal opportunity for short placement. In such a high conviction situation, it is best to position shorts early and then monitor subsequent activity for continuation. Here, the low volume area acts as a form of excess, giving credence to the developing down auction. As figure 4.46 illustrates, on September 16th, bonds gapped open below the 15th lows, indicating a potential seller continuation. The lower opening proved to be too low, however, and responsive buyers entered the market to take advantage of price perceived to be below value. Subsequent time periods showed buyers struggling to auction price higher. Eventually, the buying attempts met with rejection at the 88 to 12 level, the bottom of the low volume area separating the two distributions from the 15th. The failure to auction back into the low volume region offered traders an excellent opportunity to place shorts. Ultimately, day time frame resistance was found just below the low volume area and a single print from the previous day's selling trend structure. As with anticipating price slowing near high volume areas, it is equally important that traders avoid trading to achieve perfect trade location near the region of low volume. The keys to taking advantage of low volume areas are: 1. Keep accurate notes of where they are. 2. Know in which direction you expect to see rejection and monitor for signs of that rejection. 3. Place orders ahead of time at price levels representing good trade location and ensure execution. And 4. Abandon low volume strategies if price builds acceptance beyond previous low volume regions. A price probe pierces the balloon. Despite the obvious structural buying preference throughout the day's activity, September 16th resulted in lower value. This fact, along with the buyer's inability to auction price beyond the low volume area from the 15th, suggests that other time frame control remained in the hands of the seller. Example 2. High and low volume used together. Activity on the following day, September 19th, shows an integration of the logical workings of both high and low volume areas. In figure 4.47, the Treasury bond market opened at 88 to 09 and found early rejection just below the 88 to 11 and 88 to 12 low volume prices that formed on the highs of September 16th. Sellers easily auctioned through the 88 to 03 level despite its low volume percentage. Increasing confidence in short trades, the fact that price auctioned through 88 to 03 on the 19th confirmed that this area had supported the previous afternoon's buying auctions, or the fact that the price auction through 88 to 03 on the 19th confirmed that this area had supported the previous afternoon's buying auctions was no longer valid. From a profile standpoint, Note that the activity on September 19th generated an initiative selling tail directly below the low volume region of the 16th. In addition, the high volume levels of the 16th, around 88 to 06 and 88 to 07, slowed price enough to allow traders to take time to place shorts with initiative selling activity. Summary. The following is a brief listing of the salient concepts involved in understanding high and low volume areas. Both high and low volume regions may be present on the same day if a transition takes place. If a market evolves from balanced 2-time frame market to a 1-time frame market, or vice versa. Low volume represents rejection, but if the market should return to the auction beyond the low volume area and build value, then directional conviction has changed and that region is no longer a valid reference point. Both high and low volume areas represent support and resistance, but in vastly different ways. Number 4, traders can expect to be able to place or exit trades within high volume areas in anticipation of their slowing effect on price. Low volume, on the other hand, represents swift rejection. Therefore, trades should be placed or exited in front of that region. Or the other time frame participant that initially drove price should reject any auction attempts near the low volume area. High and low volume areas do not represent mechanical trades. They do, however, provide useful reference points that enable traders to visualize potential future activity. The importance of such reference points lies in the detection of market change. By monitoring activity around high and low volume areas, a trader can determine whether or not the directional conviction has changed since the area was formed. Through the detection of fundamental change, traders can better manage their risk and identify areas offering favorable trade location. Summary. Day time frame trading. Let's pause for a moment and imagine a vast desert with nothing but sand in all directions. A man walks along, his throat dry, his lips cracked. Suddenly, he sees before him a shimmering pool of water just over the next dune. He runs toward it. Relief, finally in sight. He reaches the top of the sandhill and jumps, only to land in more sand. The water was a mirage, created by the sun in his overwhelming desire to find water. It is important to keep in mind that at all times that the market can easily create day time frame mirages regarding long-term market direction. When a trader is looking too hard for certain market conditions and the market exhibits some characteristics of what he seeks, the result is often a mirage that can leave a trader high and dry. For example, when a market opens substantially above the previous day's range and attempts to auction down all day, it appears as if a seller is in control. A trader with a strong bearish bias might jump into a trade thinking his or her convictions were correct. However, if value is still established higher, then the buyer may actually be in control in the longer term. In this section, we discuss day time frame control, which way the market is trying to go in the day time frame. In the previous example, the seller was in control in the day time frame. In section 2, long-term trading, we delve into an understanding of the long term that can prevent a trader from being fooled by day time frame mirages, an understanding that will help a trader develop the ability to take advantages of long-term opportunity. Section 2, long-term trading. In section 1, we compared Mike Singletary to a day time frame futures trader. He studied charts and game films to prepare for each game, but operated solely in the present tense when he was on the football field. Similarly, the day time frame trader studies recent market activity, but when the trading session begins, he or she acts purely on the day's evolving information. The academic knowledge becomes synthesized in the trader's mind to form a holistic picture, allowing for objective, intuitive decision-making. The long-term trader, on the other hand, is more like Singletary's coach. A good coach knows that winning games or even division titles does not ensure long-term success. A football team may go undefeated one year, but could easily suffer a losing season the following year if the coach does not consider the long-term effects of aging players, the upcoming draft, and the changing abilities of his competitors. The coach builds the strength of his team over time, bringing in new talent and constantly evaluating the long-term factors necessary to compile a winning record. The futures market exhibits similar characteristics. The strength and duration of trend is largely subject to the aging of its original participants, as well as the talent of the conviction of the new business that is brought in. And like successful coaching careers, successful long-term trading not only requires winning consistently in the daytime frame, but also a careful analysis of all the factors that affect the market's long-term performance. The discussions in this section are designed to help traders move from focusing on each individual day time frame situation to a more holistic long-term evaluation. Only through a synthesis of both can one compile a winning record. Long-term directional conviction. In day time frame trading, section 1, we studied the progression of the information generated by the market in the day time frame. More important, we examined how a variety of structural and logical relationships produced by the day time frame auction process help to convey the directional conviction of other time frame. Because each day auctioning is contributing element to the long-term auction process, these same concepts apply equally well to long-term market analysis. Not surprisingly, our analysis of the long-term returns to the same two all-encompassing questions. Which way is the market trying to go, and is it doing a good job in its attempts to go that way? We will first discuss a series of facts that help us gauge attempted direction. Later, we examine the methods for evaluating directional performance. Finally, we unveil an easy, simple, long-term activity record designed to assist a trader in forming a holistic image of the big picture. Attempted direction. Which way is the market trying to go? When either the other time frame buyer or seller exerts a greater influence on price, a variety of observable long-term directional changes are generated by the market. Each is listed below and then discussed in detail on the following pages. They are auction rotations, range extensions, long-term excess, buying, selling, composite days. It is important to remember that these are merely attempted direction indicators. A complete understanding must incorporate long-term directional performance, which will be covered in the latter portion of Section 2. Auction rotations. In day time frame trading, we detailed a quick method for evaluating the cumulative directional attempts of the day's auction rotations. This method, the rotation factor, enables a trader to measure attempted market direction by producing a value that represents the sum of each day's half-hour auction rotations. The theory behind the rotation factor is simple. If a greater number of time periods auction higher than lower, then the buyer is exerting greater control over price in the day time frame. The market is trying to move higher. The rotation factor is by no means an all-inclusive indication of future market direction. It is, however, a useful tool in determining which way the market is trying to go in the day time frame. Since a long-term auction is composed of a series of day time frame auctions, recording and comparing the daily rotation factor can help traders gauge the strength and relative change in the market's long-term directional conviction. Range extension. Range extension signals the entrance of the other time frame participant beyond the initial balance. Persistent range extension in several time periods indicates the trade is being facilitated better in the direction of the range extension. Observing and recording continual range extension on successive days reveals a long-term tendency in the market in figure 4.48, for example. 5 consecutive days in the Swiss franc saw initiative buying range extension, which alerted traders to the presence of a strong other time frame buyers fueling the bull trend. Long-term excess. Either we defined short-term excess as the aggressive entry of the other time frame participant as price moves away from value, creating a tail in the day time frame. An example of short-term excess is evident in gold on May 2nd, 1989, figure 4.49. The 6-tick buying tail in I period was generated by strong responsive buyers who quickly took advantage of selling price probe range extension below value. Day time frame excess not only provides continual recordable clues regarding the other time frame directional conviction, but it also often stands as the pivot point marking a long-term directional move. The strong buying tail in gold, for instance, supported the market during the subsequent trading sessions. Long-term excess is caused by the same forces that create day time frame excess. When a price level is perceived to be too low in the longer term, for instance, the other time frame buyer will enter the market aggressively, forcing price to quickly auction higher. Prices that are deemed below long-term value generally form one of the three types of excess: an island day, a long-term tail, or a gap. Refer to the daily bar chart in figure 4.50 for the following discussion of the three types of long-term excess. Island day. On January 3rd, 1989, point A displays the first of the three types of long-term excess, the island day. Island days are formed by aggressive initiative activity that causes price to gap above or below the previous day's range. The market spends the entire session trading at these higher or lower levels, attempting to validate price, but returns to the previously established value on the following day, leaving behind an island of trade. On the 3rd, the yen market opened 84 ticks above the high of December 30th. After the gap higher opened, the yen continued auctioning significantly higher, only to meet responsive sellers that were aggressive enough to reverse the day time frame auction and close the yen on its lows. Because of the weak close on that day that had opened so far out of balance, the possibility was relatively high that long-term buying excess had formed. Buying excess was confirmed when the yen gapped some 50 ticks lower on the open of the following day, creating long-term excess in the form of an island day. Island days are the most extreme form of excess and often provide lasting resistance against future auction attempts. Figure 4.50 displays another island day occurring in the yen on April 4th. Point G. Long-term tails. The second form of excess does not exhibit the violent gap activity that makes the island day so easy to identify. On a daily bar chart, this is lesser form of price rejection, looks more like day time frame tail at the end of a long-term trend. One such long-term tail is evident in the Japanese yen, January 19th, in figure 4.50, point B. Compare the enlarged bar chart in figure 4.51 to the segmented profile in the daytime frame profile tail we described earlier in figure 4.52. 4.51. The tail, 4.52. The half-hour auction rotations are strikingly similar to the daily auction rotations. This is an excellent example of how the auction process applies to all time frames. Day and long-term excess is created by the same activity occurring over varying lengths of time. Referring again to figure 4.50, the yen had been in downtrend since the island day on January 3rd. On the 19th, the yen opened substantially below the 18th lows. The gap lower suggested that the downtrend was continuing. However, the responsive buyer perceived price to be below value and entered the market aggressively, creating an unusually strong long-term buying tail. The close on the highs signified staunch rejection and that intermediate to long-term excess may have been formed. When using a standard bar chart, every new low or high, it seems, has the potential to be long-term excess. How does one know which is excess and which is actually a developing probe to new value? Much like the formation of a potential day time frame tail that has not confirmed until the following half-hour time period. A long-term tail cannot be positively confirmed until the following day. However, as in the day time frame, the market does provide reliable early clues regarding the formation of long-term selling tails. For example, examine the activity of January 13th and 18th, points C and D, 2 days with similar ranges. Both trading sessions recorded new lows, but they also closed near their lower extremes, indicating the continual seller presence. In contrast, on the 19th, the yen gapped lower on the open but closed on the upper extreme. The yen had overextended itself to the downside, at least temporarily, and the responsive other timeframe buyer entered and quickly auctioned price higher, establishing potential intermediate to long-term excess. Another long-term tail occurred 3 trading days later on the 24th, point E in figure 4.50. As the seller re-entered the market after the substantial higher open and closed the yen on its lows. This price reversal occurring so soon after the relatively strong rejection on the 19th reasserted the strength of the downward trend. The final type of long-term excess is a gap. A gap is caused by initiative other time frame participants who, between the market's close and the following day's open, change their perceptions of value. Price rejection, in effect, occurs overnight, as the market gaps above or below the previous day's extremes. On the following day, on February 9th, point F in figure 4.50, an example of the yen gapped above the 8's highs, igniting a buying auction away from the balance region that had been formed from January 30th through February 8th. During a gap, a market does not create the typical tail formed that will so often signifies excess. Rather, the gap itself indicates swift price rejection, an invisible tail. In comparison to tails, gaps are actually a stronger, albeit less obvious form of excess. Note that island days are always confirmed by gaps. Summary: both short and long-term excess, when properly identified, provide reliable indications of a market's directional conviction. The price levels at which the other time frame participant enters the market and creates excess and are valuable reference points for the long-term trader. Excess is most often used as support or resistance for long-term trade location. In addition, the market returns and trades through the point of excess. A trader knows that the opposite activity is fueled by a high level of confidence and will most likely display continuation. Buying and selling composite days. Quick way to assess a market's attempted direction is known as a composite analysis. Composite analysis simply evaluates where the majority of the day's trade took place relative to the day's open. It is performed by dividing the range into 4 equal parts. If the open is in the top or the bottom 1/4, it is designated as a composite day. A composite buying day occurs when one side resides in the bottom 1/4 of the day's range. Conversely, a composite selling day is characterized by an open within the top 1/4 of the range. An open in the center half of the range indicates low directional conviction in either direction. Both B and figure 4.5 shows a buying composite day in the yen. Figure 5.43 illustrates the composite methodology. The logic behind the theory is relatively simple. If a market spends most of the day auctioning above the open, then the market is attempting to go higher. If the market trades below the open for most of the day, then the market is trying to auction lower. Keep in mind that the composite analysis does not consider the question, how good is a market doing in its attempts to auction in that direction? Remember the illustration that can arise from a market that gaps higher and auctions down all day, but develops higher value. Like all other directional measures, composite analysis must be evaluated in conjunction with value areas relationships and the high level of trade facilitation generated by the market's attempt to auction in a given direction. Summary: any combination of directional measures may be present on a given day. For instance, a particular trading session might exhibit composite buying structure, a positive rotation factor, initiative buying tails, and range extension, and higher value. unanimous indications of the market that is trying to auction higher. On some days, however, the indicators will contradict themselves. When directional measures conflict, they cancel each other out, indicating a market with less confidence in its directional course. Yet the answers to the question, which way is the market trying to go, can't stand alone. They must be considered in conjunction with the second big question, is the market doing a good job? Directional performance, is the market doing a good job in its attempt to get there? Let us return to a local grocer for a moment. Suppose that the grocer decides to expand his business by moving into a bigger building in hopes of increasing his market share. In trading terms, his attempted direction is up. Once the move is made, the question then becomes, will the expansion facilitate more trade? Over the ensuing weeks, the grocer finds that the increased shelf space does not attract new customers. His business and expense has moved up, but transactional volume has not. Disappointed, the grocer realizes that the small community cannot support a larger store. Faced with rising overhead and dwindling profits, he moves back into his old building. The futures market acts in a similar fashion, relying solely on which way the market is trying to go, or which way the market is trying to go can lead to a financial disaster, unless you can also gauge the effectiveness of the market's attempts to go that way. Monitoring attempted direction for directional performance, determining how good of a job is the market doing, is the key to a complete market understanding and long-term trading results. Once attempted direction is known, three comparative factors are useful in evaluating the market's directional performance: volume, value area placement, and value area width. Volume. As we get deeper into the long-term forces behind directional conviction, one element stands high above the rest when it comes to evaluating directional performance: volume. Not surprisingly, volume is also the best measure of a market's ability to facilitate trade. Once attempted direction is known, volume should be used as the primary means of determining directional performance. Put simply, the greater the volume of transactions, the better trade is being facilitated. In our grocery store example, the largest store did not generate additional volume and consequently failed. Similarly, in the futures market, a price movement that fails to generate a fair amount of volume as it auctions through time will likely not continue for very long in the same direction. Evaluating changes in volume. To determine whether or not volume is increasing, it is necessary to compare each day to the previous volume figures. However, there is no standard number of day time frame transactions in any market, for volume evolves with the market's changing activity. The key to recognizing change is to think of volume more in terms of market share than in actual numbers of transactions occurring, except, of course, when the number of transactions drops below that of which signifies a liquid market. Therefore, a trader must keep a running record of volume to be able to detect any significant departures from the current average. This average will vary depending upon your trading time frame. Volume as a measure of directional performance. Suppose that a movie theater raises the price of admission. In the subsequent weeks, ticket sales drop substantially. At higher ticket prices, the theater is not facilitating trade for the moviegoer. If the theater is going to stay in business, it will have to lower price. Increased volume indicates a rejection of higher prices. Volume plays the same role in evaluating the futures market's directional performance. For illustration, imagine the market's attempted direction on a given day is up, based on the positive rotation factor and buying range extension. If the buying auctions are generating healthy and increased volume relative to your determined norm, then the market is successfully facilitating trade with the buyer. Conversely, low volume on a day attempting to move higher suggests that the market is not accepting the buying attempts. Value area placement. A structural indicator that helps us better refine the level of directional performance is value area placement. Through an evaluation of the relationship of the one day's value area to the next, we can move beyond simply determining if the market is doing a good job to how good of a job is it doing. In other words, if attempted direction is up and the volume is healthy, what impact does that have on value? Were buyers successful in placing value higher? How successful were they? Was value unchanged, overlapping to higher, or completely higher? Let us briefly describe the different relationships that can exist between two trading sessions' value areas. First, value can form clearly higher or clearly lower, exhibiting obvious directional performance. Second, value can overlap to one side or another, indicating a lesser degree of change. Third, when the value area is contained entirely within the previous day's value area, it is known as an inside day. The market is in balance and not facilitating trade with either participant. Finally, an outside day occurs when the day's value area overlaps the previous day's value area on both extremes and represents greater trade facilitation. Much like a neutral day, if an outside day closes in the middle of the range, the market is in balance. If it closes on extreme, however, there is a victor in the day time frame battle for control. A close on the highs, for example, would indicate directional performance favoring the buyer. Figure 4.54 illustrates these common value area relationships. Value area placement often generates signals contrary to day time frame attempted direction. Figure 4.55 demonstrate such a scenario occurring in the Treasury bond market. On September 12th, bonds opened unchanged to higher and spent the entire day auctioning down. The result was a negative rotation factors, selling composite structure, and continued selling range extension. Clearly, a market trying to move lower in the day time frame. However, higher value was still maintained. While day time frame structure indicated seller dominance, value area placement suggests that the buyer was still in control in the long time frame. Evaluating directional performance through combined volume and value area placement. Arriving at a final evaluation of directional performance is like baking a cake, layer by layer. First, we must define attempted direction. Second, we must evaluate trade facilitation according to volume. And finally, we must determine the relative success of that trade facilitation according to its impact on value area placement. In general, if attempted direction is up, volume is above average, or at least average. The value is higher, then the market is successfully facilitating trade at higher prices. However, if attempted direction is up and volume is lower, then higher prices are cutting off activity. The buying auctions are resulting in poor trade facilitation. If the buying attempts also result in lower value when the other time frame seller is still in control of the market, despite day time frame buyer dominance, the market must move lower to resume balanced trade, much like the aforementioned movie theater. Figure 4.56 illustrates the combined effect of volume and value area in determining directional performance for the above two scenarios. Listed in Table 4.1 are 30 different relationships based on volume, value area placement, and attempted direction. 6 of them briefly detailed the following discussion. Figures 4.57 and 4.61 include an insert bar chart to show the activity following the day highlighted by each example. In addition, note that the volume comparisons in each of these examples are relative to the previous day and not a predefined average. Treasury bonds gapped open above the previous day's range and drove sharply higher. Attempted direction was clearly up, as witnessed by the initiative buying tail. Initiative buying range extension and positive rotation factor and buying composite structure subsequently substantially higher volume and the resulting higher value confirmed that the directional performance of the buyer was strong. The gold market on July 29th was clearly attempting to auction higher. And although the buying auctions managed to build value higher, volume declined, indicating poor directional performance. Underlying market conditions were weakening. The insert bar chart shows the subsequent return to seller control. After a lower opening on April 15th, bonds spent most of the day attempting to auction higher. Long-term traders relying solely on attempted direction might have bought, perceiving day time frame buyer control and an opportunity to acquire a relatively good intermediate term trade location. However, an upward auction attempts actually discouraged trade and were unable to return the value to the levels of the previous day. The buyer's directional performance on this day was very poor and indicated long-term control was in the hands of other time frame seller. On September 20th, gold opened and tested above the previous day's highs. When no continuation developed, other time frame sellers entered the market and auction price lower all day. Attempted direction was down, accompanied by lower value and higher volume. Directional performance on this day clearly favored the seller. Attempted direction was obviously down on this opening drive selling day. However, the day's selling attempts only managed overlapping to lower value and basically unchanged volume. This scenario generally indicates a market that is continuing but slowing and coming into balance, or a market that is in the midst of a gradual transition. Subsequent trading sessions should be monitored carefully for signs of directional conviction. Value area width. One drawback to the day trading is the exact volume figures are usually not available until after the trading session is over. However, one practical way to gauge the level of volume as the day develops is through the value area width. On days where volume is relatively low, the value area on the length of the range tend to be narrow. For example, the Treasury bond on April 17th, 1989, figure 4.62, the value area was only 2 ticks wide. Volume was at a scarce 120,000 contracts. In this particular case, the lack of facilitation was due to the fact that traders had balanced their positions in anticipation of the producer price index figure to be released on the following day. Conversely, value areas tend to widen on days exhibiting higher volume. Figure 4.63 on April 27th, the value area was a healthy 16 ticks wide. Volume on this day was just short of 600,000 contracts. The logic used is that the wider the value area, the greater range of prices at which trade is being conducted. See table 4.2. This results in increased participation, for as price auctions higher and lower, different time frames are bought into the market and they perceived price to be away from value. The further price travels, the better the possibility that new activity will enter the market, thus creating greater trade facilitation. We conducted a limited study comparing total volume with average value area width for Treasury bonds from December 14th, 1988 through June 22nd, 1989. Figure 4.64. As one would expect, the data clearly showed a marked increase in volume on days with larger value areas. For example, the average volume on days with a value area of 1 to 5 ticks wide was 127,000 contracts. Days with value areas 11 to 15 ticks, however, averaged roughly 284,000 contracts, while the value areas from the 21st and the 25th ticks were regularly around 313,000 contracts. Summary. Long-term activity record. We now have covered a variety of ways to measure attempted market direction and directional performance. Keep in mind, however, that focusing on just one method can lead to tunnel vision and an incomplete understanding of true market conditions. It is necessary to synthesize all the elements of direction and performance to arrive at a holistic market understanding. Figure 4.65 contains a simplified long-term activity record, LTAR. You guys have seen this before, you should have. Designed to help traders organize the answers to the two big questions addressed in this section. Figure 4.65 is left blank for you to fill out and copy if you wish. However, we encourage you to create your own long-term activity records that better fits your needs and trading time frame. To illustrate the use of the LTR, we have isolated a brief period in the soybean market and recorded the attempted direction and direction performance for each day. Figures 4.66 through 4.74 show soybean activity from May 16th to the 22nd, 1989, and the compiled LTARs that correspond to each day. Okay, it doesn't talk about them. This. The open is here. Rotation factors, -11. Selling trend day. Right, just examples based off of the market. I encourage everybody to buy the book, or get the book so they can make their own version. Long-term auction rotations. The auction process is akin to a virtual tug of war, with price moving higher when buyers are in control and lower when sellers are in control. The auction rotations are, in a sense, the structural footprints of the rotational struggle between the other time frame participants. In the day time frame, the auctions take the form of either one time frame or two time frame market conditions. Long-term auction rotations are composed of the same form of activity. However, the footprints are recorded over a longer period of time. A bracket, for example, is a long-term two time frame market, while the trend is a long-term one time frame market. Just as a day trader must be aware of time frame control, it is crucial for a long-term trader to know whether the market is trending or in a bracket. The following discussion details the long-term trade applications of bracketed and trending markets. Our goal is to arrive at methods to objectively assess long-term market movement. Brackets. In review, markets spend approximately 70% of the time in trading range, or bracket, in which the other time frame buyer and seller become responsive parties. When the market is bracketing, the other time frame participants have similar views of value, and the prices at which they are willing to do business grow much closer together. As price nears the top of the perceived bracket, the seller responds and auctions price downward. In turn, the responsive buyer enters at the lower bracket extreme and rotates price back to the upside. As the market attempts to facilitate trade between the buyer and seller, price movements tend to be volatile, auctioning back and forth with no real long-term directional conviction. Figure 4.75. It is difficult to define the bracket in absolute terms. As with a trend, seldom do two traders have the same definition of a bracket, for all traders operate with different time frame in mind. The daily bar chart for the Treasury bonds in figure 4.76 can be broken down into a myriad of individual brackets. For example, the entire bar chart could be considered a bracket by a long-term trader spanning some 6 months. Point 1 in figure 4.76, the long-term participant might seek to buy below 87 and sell above 91. A short-term swing trader, on the other hand, might break the bond market down into smaller brackets, as shown by point 2 in figure 4.77. Balanced region encompasses roughly a month. The swing trader would attempt to place longs around 88 to 00, then exit and go short above 89 to 16. Figure 4.78 illustrates some of the many possibilities of brackets contained within the bond market over this particular 6-month period. There are brackets within brackets within brackets. Depending upon your trading time frame, at point 5 in figure 4.78, a short time frame trader might consider 6 days of overlapping value to be a bracket. A long-term trader, however, would consider that region to be part of a long-term bracket at point 4. Even if two traders agree on a balance area, they still may differ on the actual extremes of the bracket. In figure 4.79, one swing trader might consider the bracket extremes to be created by reoccurring value area tops and bottoms. Other swing traders might use price extremes excess to define the bracket as at figure 4.80. The point is, bracket definition is largely a product of time. There is no perfect bracket, just as there is no perfect trend. The important concept to remember is that to successfully trade in a bracketed market, it is necessary to clearly define the bracket in which you are trading according to your time frame. It is helpful to literally draw in the bracket extremes as you perceive them. This allows you to visualize future auction rotations and ideal trade location. When you clearly define a bracket, you are in effect testing your market understanding. Brackets do evolve, however, and it is important to consistently monitor for fundamental changes by observing and continually reevaluating your view of the bigger picture. You will gain experience and further the learning process that is necessary to becoming an expert trader. Trade location in a bracketed market. Once you realize that you are in a bracketed market and you have defined the bracket extremes, several guidelines can help you secure proper trade location, improve your trading performance, and manage your risk. Rule 1. Monitor market direction and location within the current bracket. All trades in a bracketed market should be placed responsively. We use the term responsive here in a more generic sense than has been previously discussed. Consider it this way. The distance from the top of the bracket to the bottom, regardless of the bracket's size, is similar to the day's range. Therefore, the value area is contained within the middle of the bracket. Longs placed below the bracket value area are considered responsive, and shorts placed above. Any trade positioned in the middle of the balance area is an initiative and offers poor bracket trade location. At point 1 in figure 4.81, for example, the responsive seller responds to price approaching the top of a bracket. Shorts entered at this point, resulting in minimum upside and exposure to relative to the downside profit potential. If the market continues up, movement to the upside should be slowed by resistance at the top of the bracket. This would allow a trader time to evaluate the trade and, if necessary, exit at the short at a minimal loss. At point 2, however, activity is initiative and trade location is poor for short positions. Immediate upside exposure is equal to downside profit potential. A long placed here embodies even greater risk, for the current medium-term auction is down. The market eventually auctions back to the top of the bracket at point 3. Longs placed here with the initiative buyer offer little upside potential, with the risk of price returning to the bracketed lows. Shorts should be entered at the upper extreme with the expectation that the long-term sellers will respond to price above value. If price auctions above the bracketed top, however, the market may be poised to break out of the balanced area. If price is accepted above the bracket, shorts should be exited and longs placed with the breakout activity. Conversely, if the upper extreme offers resistance and price is returned within the bracket, shorts offer excellent trade location. In both cases, trades should be monitored carefully, for movement is often swift coming off of a bracket. Rule number 2. Markets generally test the bracket extreme more than once. If you miss an opportunity to sell a bracket top or buy a bracket bottom, do not scramble to enter the trade for the fear that you will not get another chance. Chasing a bracketed market only results in poor trade location. Over a large sample size, the market will return to test the bracket extreme on the average 3 to 5 times before moving to new levels with confidence. Rule 3. Markets fluctuate within bracketed regions. As market generally will not auction from one extreme of a bracket to another in a beeline, rather price fluctuates within a balanced area, from top to middle, middle to top, middle to bottom, and so on. Due to price fluctuation, swing trades placed in the middle of the bracket offer poor trade location. Rule number 4. Monitor activity near the bracket extremes for acceptance and rejection. If price auctions near a bracketed low, it is easy to let objectivity slip and begin to anticipate that the market will travel through the bracket. After all, recent activity has been to the downside. Why should it stop now? However, it is extremely dangerous to place a short at the bracket low before the market has exhibited acceptance and follow through below the bracket. If you were wrong, you have positioned yourself with the worst possible trade location in the market that will most likely auction back to the bracket's upper extreme. Remember, in a bracketed market, both other timeframe buyer and seller are responsive participants. Responsive activity is generally much slower and more gradual to develop. The trader usually has time to monitor the bracket extremes for rejection or follow through. Transition bracket to trend. All brackets eventually evolve into some form of a trend, just as all trends end in a balancing area or bracket. It is an ongoing cycle. Because of the vast difference in trading techniques during the trend and the bracket, it is necessary to be able to identify when such a transition is occurring. Again, because every trader operates within different time frame, it is impossible to positively define a perfect transition rule. Traders with exceptionally long time frames might consider a year-long trend to be part of a larger bracket. Conversely, a swing trader might consider a week of consecutive higher value areas to be a trend. Identifying the transition from bracket to trend is a product of your personal time frame. In day time frame trading, we discuss transition in terms of one time frame and two time frame conditions. The same concept can be applied for long-term auctions. When a market is in a bracket, both the other time frame buyer and seller are present and active over a longer period of time. There is no clear long-term directional conviction. A transition occurs when the initiative participants exert more control over price than the responsive participants. In the long-term transition, it is marked by the formation of excess confirmed by sustained follow-through in the opposite direction. The beginning of an uptrend, for example, is usually marked by the aggressive entry of the other timeframe buyer, creating excess in the form of a long-term buying tail or buying gap. The responsive buyer overwhelms the seller, and the market begins to trend upward, turning initiative and as it passes through previously established value. In figure 4.82, the buyer entered responsively at point 1 within a balanced area. The subsequent initiative buying gaps at points 2, 3, and 4 established strong long-term excess and confirmed the conviction of the initiative other timeframe buyer. This gapping activity began on an upward trend that spanned some 4 months. In the intermediate term, a transition might take the form of a balance area breakout. In figure 4.83, for instance, the S&P had developed 3 days of overlapping value. On February 7th, the S&P broke out of the balance area, indicating a transition to a trending scenario. The result was a double distribution buying trend day. Similarly, Treasury bonds exhibited an intermediate term transition from a bracket to a trend on April 9th, figure 4.84. After 8 days of overlapping value and multiple distribution trend day signaled the re-entry of the initiative other timeframe seller with strong directional conviction. Trends. A trend is a result of a clear control of directional conviction by either the other timeframe buyer or seller. The stronger the conviction underpinning the trend, the greater the success that usually sparks the trend's beginning. In other words, a trend of great magnitude will typically have an elongated long-term tail and or large gap invisible tail that creates a firm base from which the trend begins. In figure 5.8, it follows that early trend activity will tend to be more dramatic and pronounced, witnessed by more range extensions and elongated profiles and substantial tails. So familiar. Trade location in a trending market. There's no such thing as good trade location during the early stages of a trend. If the market is truly trending, price will continually lead value. The key to trade location is simply to get on board early and then monitor the market for continuation. If a trend is strong, your position should be rewarded with follow-through and your trade location should improve. If not, then the trend is suspect and trade should be exited. Early entry in a trending market is more difficult than it sounds, for it means that the trader must buy considerably above recent perceptions of value. Picking up the phone and saying buy it when price is quickly auctioning above the last several days' value areas can be nerve-wracking experience, even for the trader who is usually calm and objective. When a trend emerges after a prolonged balance area, a trader must quickly reverse his or her trading perspective. It is very difficult to change from a responsive mode to a go-with trailblazing mentality of the initiative trader. Later in the life of the trend, however, a trade should be placed responsibly, or when the market temporarily breaks during an uptrend or rallies in a downtrend. Regardless of where you are within the long-term trend, it is safest to trade with the trend. You will save the cost of this book 10 times over if you simply do not trade against the trend. Monitoring trends for continuation. One useful way to monitor a trend for signs of continuation and or slowing by comparing activity on the up days against activity occurring on down days. While in an uptrend, for example, determining which way each individual's trading session is attempting to go, then compare the volume generated on down days versus the up days. If a trend is strong, up days should exhibit greater trade facilitation by generating higher volume than down days. When volume begins to increase on days against the trend, then the trend is aging and may soon begin to balance or enter a bracket. Transition trend to bracket. A trend is officially over when the responsive participant is able to exert as much influence on price as the initiator. An uptrend has ended, for instance, when the responsive other timeframe seller is able to create significant excess at the top of the trend. Once the trend is over, the market will begin to balance. As the market begins the bracketing process, traders should revert to responsive mode, seeking to sell the top of the bracketed market and buy the bottom. Examine figure 4.85. Containing the daily bar chart for crude oil, the long-term trend that began in late November 1988 began to balance when the responsive seller was strong enough to induce a gap lower opening on March 28, 1989. Although the resulting excess did not last for long, it indicated that the initiative buyer was weakening and a trading range was developing. Figure 4.86 provides a second example of the transition from trend to bracket, although over a much shorter time period. After two strong buying days on January 19th to 20th, the Japanese yen began to balance. The inability of the buyer to establish continually higher value indicated the presence of a responsive seller. The yen had entered a short-term bracketing period, as evidenced by responsive activity on both extremes of the bracket. See circled areas. Where's these circled areas at? Yeah, maybe it's waiting for me to draw a circle. Detailed analysis of a developing market. To bring concepts of the bracketed market to life, we will now take a detailed look at the developing Treasury bond market from late October 1989 to early May 1989. We have specifically chosen this time period for its volatility. A volatile bracketing market is a complex and emotional, difficult market to trade. In a trend, trade location is simply a matter of am I too late and can I buy above or sell below value? Trading in a bracketed market, however, is much more challenging. To be successful, traders must mentally change gears, literally trade from several different states of mind. Since markets generally spend 70 to 80% of time bracketing, such a challenge is the norm, not the exception. In futures trading, in a bracketed market, the other time frame buyer and seller are much closer together in the perception of value. See bracketed markets in Chapter 3. Both are actively probing to determine the condition of the marketplace. As an illustration, consider the development of the computer chip industry. Early on, when microchips were suddenly in great demand, but only produced by a few suppliers, prices trended steadily higher. However, new producers entered the marketplace and existing suppliers increased their output. The computer chip market entered a bracketing phase. Price began to auction back and forth between the long-term participants as their perceptions of value started to narrow. Buyers and sellers, in effect, were testing each other to determine the condition of the market's attempts of the market. Attempts by producers to raise price were sometimes rejected as buyers found alternative, less expensive sources. Conversely, sometimes higher prices were accepted due to temporary flux of buyers. Bracketed reference points. To successfully trade a bracketed market, you must first recognize that the market lacks long-term directional conviction and consequently become more selective in your trading. In other words, it is essential that you develop both a hands-on strategy and a minds-on approach to evaluating the market's auctions. Because of the closeness of time frames, the market's probes for acceptance of value appear to be extremely disorganized, often to the point of random rotation. We will show you that in some cases this is actually true. However, there are many other time frames when the footprints of the market's auctions provide valuable information regarding short-term conviction, enabling alert traders to identify change in its early stages. The key to selective trading lies in the understanding, recognizing, and recording a few very basic reference points. Not surprisingly, these reference points are generated by many of the market forces that we have already discussed. Forces such as market balance, non-trend days, balance breakouts, and auction failures. Before we delve into our detailed Treasury bond example, let us first recap on a few of the forces that shape a bracketed market. A market that lacks directional conviction spends the majority of its time in a very short-term balance areas. Intermittently, the market will break out of the balance region and make a swift directional move to a new price level, whereupon it again returns to balance. This chain of events happens again and again until conditions change significantly and sustained other time frame conviction surfaces. Until then, it is wise to maintain a relatively short trading time frame. Generally, a trade should be held overnight only if there is substantial structure evidence in its favor. There is little opportunity in short-term balance regions, for they usually lack any semblance of directional conviction. The sharp price spurts between the balance areas, on the other hand, last for the short period of time, but offer a high degree of opportunity for a trader who is alert and prepared to take advantage of them. Because of the swift nature of the breakout, traders must not only be able to recognize the auction behavior that leads to the probe away from balance, but also have the foresight to enter orders ahead of time to take advantage of the potential breakout. The key to early identification of a breakout lies in the concept of market balance. In a bracket, the market develops a series of short-term balance areas, brackets within brackets, or consecutive days of overlapping value in most cases. The direction of the market breakout of these short-term balance areas proves to be the beginning of at least a short-term auction. The salient concept is follow-through. Monitoring a breakout for continuation is the key to identifying other time frame control. In large majority of cases, a breakout will begin to either a gap or an auction failure. After several days of overlapping value, a gap opening indicates that the market is out of balance and could be breaking out in the direction of the gap. A more subtle form of breakout occurs when the market tests one extreme, fails to follow through, and then breaks out in the opposite direction, forming an outside day, like today. A day that extends beyond previous days' sessions extremes, for example, consider a market that develops overlapping value on 6 consecutive days. On the 7th day, the market tests below the balance area lows, fails to follow through, and then auctions quickly to the upside, forming an outside day. The initial auction failure is the first indication that the market has the potential to break out of balance, for it forms excess and establishes a known reference point. The frequency of the behavior is witnessed by the great number of substantial day time frame price movements that are also outside days. We emphasize, however, that observing market behavior and actually placing the trade are two entirely different actions. After several days of overlapping value, for example, it is easy to grow accustomed to the seemingly random back and forth balancing. When the market finally tests below the short-term bracket lows and fails to follow through, it is relatively easy to recognize the potential for an outside day. However, the ensuing auction back through the balance area appears to be the same activity and has lulled the trader to sleep during previous days. As one trader put it, I can identify the auction failure and I know that there is good possibility that the market will move substantially higher, but I just can't pull the trigger. The phone gets extremely heavy. Trading in a bracketed market is by no easy means. Even with clearly defined reference points, as we stated earlier, you must do the trade in order to build the experience and confidence necessary to take advantage of sound market understanding. As you proceed through the dissection of the treasury bond market, one fact should ring loud and clear. Overlapping value regions, auction failures, breakouts, and the resulting outside days happen over and over again. They literally form the backbone of a bracketed market. As you become more familiar with their formations and consistent behavior, what once seemed to be virtually random, unorganized behavior will begin to take a new meaning to make sense. You will realize that through these apparent random actions, the market is actually organizing itself, fulfilling its purpose, facilitating trade. For the trader, these behaviors are resulting structural features draw a roadmap that is so crucial to selectively taking advantage of the dynamic short-term price movements that characterize a bracketed market. The points discussed below are highlighted in figures 4.87 through 4.90. Farther are we? This chapter's over. I think we're going to stop here, guys. About an hour in. Doing pretty good. Yeah, got a lot done today. But yeah, you guys have a wonderful rest of the day. If you're trading, make sure that you are managing risk and sticking to your trade plan. Appreciate everyone hanging out, and I'll catch you guys later.